What we're going to move on to now is the market for loanable funds. So when we're talking about loanable funds, remember, what do we mean by funds? We just mean that there is resources being channeled from savers to borrowers. Okay? So there's a lending and a borrowing process happening. So what determines the demand for loanable funds? Essentially, the demand for loanable funds is driven by investment. And investment, the quantity of investment that a firm will be prepared to engage in other words, the amount of spending on investment they would like to do, depends on two things. First, how much is it going to cost to borrow the money? So this is the cost. Okay, that's the cost. And how much am I going to get from that investment? In other words, what is the revenue or what is the benefit? Okay, so normal story, cost benefit analysis. When you invest, what is the cost? The real interest rate. That's what I have to pay for borrowing the money. Well, borrowing in this instance, I say the money, but I'll clarify what I mean by that just now. Expected profit, in other words, when I've used money to purchase investment, that investment goes into capital, that capital generates revenue, it's going to generate a profit. If that profit that I get from buying that capital does not exceed the cost of raising the funds for that capital, then it's not a good idea for me to go and get that investment. Okay, so what is my profit versus what is the cost? So then I think the intuition here is pretty straightforward. As the real interest rate decreases, right, firms are more and more likely to be able to borrow money and invest in something that's going to earn a profit, right? In other words, let's say that firm can borrow money and invest in a project. When it invests in that project, it's going to make a profit off that project, and the profit of that project is going to be 10 Rand. Okay? It's not a great project, but it's 10 Rand, whatever. Cool. The company goes out into the market and says, we'd like to borrow some money for this project. What is the interest cost on the money that I borrow going to be? Let's say the interest cost is 20 Rand, right? So my interest cost is 20 Rand up here somewhere. My profit is 10 Rand, and it's going to cost me 20 Rand to borrow the money in order to generate that 10 Rand. Is that a worthwhile investment? I get 10 Rand in profit, and I pay 20 Rand in interest. Have I gone up? Am I in the green? Have I got a positive amount? No, I'm negative 10, right? Okay, so let's say that instead of being an interest rate of 20, let's say the interest rate instead was 15, right? Do I now engage in my project which generates a profit of 10? No. Okay. Eventually I go into the market, whatever, in a different scenario I go into the market and the cost of borrowing is 8. The profit is 10, the cost of borrowing is 8. Do I then do that project? You're happy that that's going to be the case, right? So are you happy then that the lower the interest rate goes, the more likely companies are to have projects or engage in any kind of activity that's going to generate a profit that exceeds that interest rate? The lower the interest rate, the more likely you are to have a project that exceeds that interest rate as a return. So if your project generates a 10% return, at any interest rate below 10%, it's profitable for you to do it. Any interest rate above 10%, it's not profitable. And remember what happens as we invest more and more and more capital into things, what do we know about the returns? Diminishing, right? So as we invest more and more into projects, the return that those projects are going to generate is going to be less and less. Which means that in order for firms to continue investing more and more and more money in projects that are earning lower and lower returns, the only way firms are going to be incentivized to do that is by being offered a lower and lower interest rates. So are you happy, therefore, that the investment demand curve, which is essentially the same as the demand for loanable funds, is downward sloping? If we look at the real interest rate and we plot real interest rate against investment, are you happy it's a downward sloping curve? Everyone happy with that? Quantity of investment basically means the same as quantity of loanable funds borrowed, right? Because what do we use loanable funds for? Investing. Okay? So where it says loanable funds, that's the same as saying investment, right? Demand for loanable funds is demand for investment. Are you happy with that idea? Okay. So our demand for loanable funds curve is the relationship between the quantity of loanable funds demanded for investment and the real interest rate. What then causes a change in the demand for loanable funds? In other words, what shifts the loanable fund curve, demand for loanable fund curve, to the left or to the right? Well, we've already said that the thing that determines how much will be demanded for any given interest rate is the profitability of the projects or the investments, right? So if suddenly firms find themselves in a situation where all their projects, any project they wanted to do, is suddenly more profitable, what does that do to the quantity of loanable funds demanded at any given interest rate? What happens to the quantity of loanable funds demanded at any given interest rate if projects are more profitable? Yeah? It goes up, right? So if the quantity of loanable funds demanded goes up at any given interest rate, then your demand for loanable funds shifts to the right, right? In other words, when you expect greater profits, right? So when your profit, you expect greater profits, when your profits on any project increase, then your demand for loanable funds shifts to the right, because you want to invest more. Now, what these slides don't do, for some reason, is present the supply of loanable funds. So let's draw that quickly. Okay. So if we have a market for loanable funds, so we've got quantity of loanable funds, and you got the price. What is the price of a loanable fund? It's the interest rate. Okay. Demand for loanable funds, we know, is decreasing. And demand, who demands loanable funds? Investment. Okay. What about the supply of loanable funds? In other words, these are the guys, the people that are demanding loanable funds are the investors. These guys are the borrowers. These guys are going to be borrowing loanable funds. Who then is supplying loanable funds? Supply of loanable funds is going to come from savings, right? In other words, these are the guys that are lending. You happy with that idea? Now, the supply of loanable funds, if we think about what about the relationship between the quantity of loanable funds supplied and the interest rate? What is going to induce you to save more? As the interest rate goes up, are you happy that people then are going to be inclined to save more? Are you happy with the nature of that relationship? Yeah? Okay. So then our supply of loanable funds curve is going to be upward sloping. Now, for the rest of this course, whenever we think about investment and we think about what happens when interest rates change, we concern ourselves with investment. When interest rates change, what happens to investment? That's what we're going to be dealing with as the course progresses. We don't ever really talk anymore about what happens to savings. Savings is just not part of the discussion anymore. So whereas we have an upward sloping savings curve, which says that the relationship between savings and interest rates is actually positive, what we ultimately end up doing when we look at how this works is we plot investment as downward sloping, interest rates, quantity of investment, and we say that when the interest rate, for example, decreases, what happens to investment? It increases. Okay? There's no discussion in this example about savings. Of course, what we start with is simply the interest rate decreases. What is going to cause the interest rate to decrease? In this particular example, the only thing that can cause the interest rate to decrease is essentially if the supply curve was shifting to the right. That's how our interest rate would be decreasing. So if you really want to understand more about what's happening in this diagram in relation to savings as well, then what I would suggest, what I would suggest is thinking instead not of a supply curve that is upward sloping, but just a supply curve that is vertical. If our supply of loanable funds was vertical, what does that tell us about the interest rate and the quantity supplied? There is actually no relationship. Are you happy with that idea? So we can have many different types of supply of loanable fund curves, but for the rest of the course, what we implicitly assume essentially is that the supply of loanable funds is vertical, and that when we change the interest rate, what we're really doing is just shifting the supply of loanable funds. That's never explicitly stated, but that's what's implied. And the implication is that in fact savings has no relationship to interest rate. That's kind of the assumption that we take forward. You'll see as we do the chapters that bring together aggregate demand and aggregate supply, and we talk about changes in interest rates, you'll see there's no discussion about savings, which means the implicit assumption is that your loanable funds, your savings, your supply of loanable funds is vertical. That's the easiest way to think of it anyway. So that's our loanable funds market. We've got demand and we've got supply. Everyone happy with those concepts? Straightforward? Any questions? Cool. What is going to shift the supply of loanable funds then? Well, so the factors, in other words, the real interest rate is not going to cause a shift. A change in the real interest rate causes what? A movement along the curve. Anything other than a change in interest rate, so if this is the interest rate and this is loanable funds and this is supply, change in interest rate causes a movement along the curve. Change in anything else is going to do what? That's right, it's going to cause a shift in the curve to the left or the right. Okay. So as we say, what happens? Change in the supply of loanable funds. If your disposable income changes, if anything related to income or wealth changes, or alternatively, and the textbook doesn't really go into much detail about this, but bear in mind that the interest rate that you earn is from an investment, right? And that investment has a certain amount of risk attached to it. If an investment is very risky, you expect a high rate of return. So if something happens in the economy that makes all investment more risky, in other words, you're less certain of how successful those investments are going to be, you demand a higher interest rate. Happy with that? Any issues or questions? Equilibrium, straightforward. Where our two curves intersect, we've got our equilibrium interest rate. When we change demand or we change supply, we get a change in equilibrium quantity and we get a change in equilibrium interest rate as well. When we shift the supply curve up or down, we get a negative relationship between the price and the quantity. When we shift the demand curve up or down, we get a positive relationship between the quantity and the interest rate, right? What I had stated in a couple of slides back was that this interest rate that this relationship was negative, right? That negative relationship is based on this investment demand curve, because as I said, that is the one that we are most interested in. So what happens when interest rates go down? Quantity of investment goes up. And now, without going into too much detail, what that means is that the people that are demanding loanable funds are the people that are also supplying bonds into the bond market, because how do you get a loanable fund? You offer a bond to the market, you sell your bond, and you get funds, okay? Which means the supply of your bonds increases, which means the price of your bonds increases. If you didn't understand that, I totally accept that that is the case. We will talk more about the bond market. As I say, the textbook doesn't go into much detail about the bond market. You don't need to know much about the bond market. I will, if you want me to, talk more about the bond market, not right now, though. So this negative, where I said this relationship is generally negative, it's because I'm focusing on this investment demand curve, which means it's the supply of bonds, which means when interest rates go down, that's the same as an increase in quantity of bonds supplied, which means the price of bonds increases. But we will talk more about that, just not at this stage, because it's not important for the loanable funds market. Okay. Yeah, we've spoken about all of these different issues, except this point here, and I think probably this might be a good place to stop.